Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Joshua Crabb, Old Mutual Global Investors, Head of Asia Equities. Hello, Joshua.
Good morning, Emma.
So we've just heard today that in about a month's time, the President of China may well be visiting the President of the United States in the US. Now, this has been a concern for emerging market investors, Trump being elected to the White House, because he has been pretty inflammatory in some of his comments towards China. So, as an investor in Asia equities, do you think this is an opportunity or a headwind?
I think it is an opportunity. There will be, losers and winners out of these events. But I think there's a couple of things to consider. One, politicians' bark is often worse than their bite. So we are, as was made clear during the debates with Hillary, Mr. Trump, or President Trump as he's now known, has been quite happy to use Chinese steel and Latin American labour. I think the second point to keep in mind is this still needs to get through a Republican, Senate and House. And if we consider, even with very popular presidents like Obama, the inability to get things through is quite difficult. And Republicans for hundreds of years have actually believed in open trade. So I think that will be less of a headwind than people, sort of anticipate going forward. Now, I think the interesting thing on sort of protection element is really the impact that it's going to have. So are there many people, for example, who sit in the US who are going to want a $3 an hour job? And I don't think there are many. And this is the interesting debate because people often look to China, whereas where we've seen a place to be more concerned has actually been in, ironically, a place like India. And that's because there is some very expensive, well-owned sectors in pharmaceuticals and IT, much higher paid, much more likely to come under attack from the US, and much more likely jobs that actually could move back. So I think it's really about understanding where those risks sit and taking advantage of them.
Now, having a look at your portfolio and your top 10 holdings, I can see there are 5 Chinese banks and indeed 1 Indian bank there. Now, Chinese banks are quite a contentious issue among investors. There are concerns about debt levels and indeed the opacity of investing in a Chinese bank. So why are you positive on them?
This is a very long topic, and we could go through the issues around state-directed investment and how that means the government stands behind them, etc. But I want to just put this in simple terms for now, because rather than talk about the very long-term issues, let's just talk about what's immediately happening. So the Chinese banks were very cheap. They were very low on price to book, low to PE, and they were still paying dividends. We often find that when banking systems go under duress, the first thing they do is cut back on the dividends, which makes sense. And they've continued to pay those in China, which means you are paid to wait quite handsomely. So the second aspect is around, so what are these projects they've lent to? Now, in China, rather than government raising bonds and investing in public infrastructure, they get the banks to do it. Now, the thing about public goods is they don't make money. And as a result of this, the government effectively stands behind some of these things. We've seen restructuring as these have moved from local government entities that can't raise money into the central government. So that's one aspect. The second aspect is around bad companies that they may have lent to. And one of the aspects here we think is very important is what's been happening with the PPI, or the Producer Price Index. That has been negative for many years in China, which has meant that companies, despite the destocking, the deflation environment, have found it very tough. When the value or price of what you're selling is going down and there's no natural volume offset, it's very tough. If you're a bank that lends to that, it's also very tough. Over the last short period, we've seen that going from being many years of sharply negative to being very positive, with the last print of 7.8. And what this means is that pricing power is starting to improve, which means that the system is getting better, the profitability is getting better, and therefore those bank loans are getting better. And in our view, they're just too cheap for this environment that we're going through now, because people are too busy looking backwards. In the same way in 2007, when people were paying things like 5 times price to book for a China Merchants Bank and thought it was a good idea, and they were looking backwards, not forwards, we think they've been making the same mistake at the moment.
Now, both of those answers have been very positive, but bearing in mind the fact that we have had incredible rally in Asian equities, how positive are you looking forward as to what we can expect in terms of growth as a shareholder of Asian equities?
Yeah, look, absolutely. And the way I like putting this is into a framework. Everyone's got views. And the way I sort of look at it at the moment when we look at most investors, there's a couple of observations we can make. Most people are still underweight. Most people are still positioned very, very defensively in high quality assets, in growth assets they see independent of the cycle. So in that backdrop, we now have a market on 1.6 times price to book. If we look at 20 years of history and look at your probability of making money over a 12-month period at various price to books, it is still very, very favourable at 1.6 times. Interestingly, February last year, when everyone was panicking, when it was at 1.2 times, history suggested 100% probability of making money. Now, the framework that we sort of loosely are using at the moment is it feels a little bit like 2003, 2004. And if you remember back then, the US had come out of the tech bubble and crash and was starting to do okay, was pretty highly valued in the same way as it is now. People looked at Asia, they were very negative. Back then, it was because we had the bombings in the nightclubs in Bali, coups in Thailand, we had had property prices in Hong Kong halve, and we'd had SARS. And people forget these issues, but it traded at a massive discount, similar valuations today. The US had come out, that growth had started to spread globally. The US, which I'll come back to, actually raised rates during this period, and Asia massively outperformed as that global growth spread. When we look at the world today, we see a very similar environment. The US is fine, but it's quite expensive, but it should be able to hold in there. Asia is still very cheap. The Fed is likely to raise rates. Everyone thinks that therefore the Fed raises rates, the dollar is strong, Asian equities underperform. If you look at 2003-4 to 2007, the Fed hiked much more than people are anticipating now. The DXY, or the dollar after an initial rally, then sold off. Why? Not because it didn't raise rates as people were anticipating, but the rest of the world got better relative to expectations. And we see a very similar environment at the moment. So we think on a range of sort of that 1.0 to sort of 3 times price to book over time, sitting at 1.6 today, with earnings revisions turning positive, it's still quite a good outlook for Asia.
Joshua, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.